Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. Working as an architect in the 1990s, Tania Reif saw firsthand the devastating impact on local communities of the currency crisis events that occurred with some frequency in her home country of Venezuela. Gripped by the field of macroeconomics, Tania ultimately earned a PhD from Columbia University, writing her dissertation on episodes of currency crisis. Our conversation brings to life Tania's framework for the why of FX crisis events. In this context, she shares her assessments of the multiple events in the 1990s, contrasting these with today's more stable emerging market FX environment. Pointing to a fixed exchange rate regimes, Tania describes the vulnerability that comes from a sudden stop of external financing after a period of excessively loose monetary policy. The result, a balance of payments crisis that leads to a large currency depreciation and inflation shock. We also discuss financial contagion, and Tania makes the point that when countries have parallel risks, an event in one country can have implications for regions that investors deem similarly vulnerable. Unsurprisingly, amidst our discussion on foreign exchange dynamics, we also discuss today's era of remarkably low rates, pointing to the opportunity to capitalize on low borrowing costs to improve the circumstance of those impacted by the pandemic. Tania argues that if easy monetary policy does not ultimately translate to higher productivity and growth, we risk being stuck in a world of very low rates for a very long time. Lastly, we discuss cryptocurrencies, an asset class that Tania has strong interest in and is very optimistic about. The fixed supply of Bitcoin, relative to the ongoing debasement of fiat currencies, addresses the conflict that individuals and central banks find themselves in. With a view that the institutional adoption of crypto is increasing, but still has far to go, Tania is bullish on growth in the market cap of Bitcoin and believes investors should have some portfolio allocation. Please enjoy this episode of the Alpha Exchange, my discussion with Tania Reif. The views expressed in this podcast are the individual views of Tania, and in no way do they represent the views or trading positions of Alphadyne. My guest today on the Alpha Exchange is Tania Reif. She is a member of the investment team at Alphadyne, a hedge fund here in New York. Tania, thanks for joining me today on the Alpha Exchange.
Thank you for inviting me. This is a lot of fun.
I'm so glad we got a chance to do this as we round out the year of 2020. Quite a year in markets, in the economy, so much uncertainty, so much volatility, things that we never thought could or would happen have happened. So we'll have plenty to talk about in the world of global macro and your assessment of risk. As we get our conversation underway, I would love to learn a little bit about your background. You've earned a PhD, which is no small feat. So congratulations on taking the academic side of things all the way to the end. Tell us how you got started in the area of finance and what you studied in pursuing your PhD.
My background is actually quite unique for our field. If I start right from the beginning, I actually studied architecture back home in Venezuela, where I grew up. I was actually working as an architect when we had one of the biggest financial and currency crises. But that was no exception because we had, through many years while I was growing up, basically a financial crisis, a currency crisis every couple of years. And every single time I was wondering whether these big devaluations would actually help the country move forward and make us more competitive. Of course, not understanding well economics, macro, anything related to the oil economy where I was living in. Things just got worse and worse with time. And obviously, now it's a complete implosion of the economy today. I really, after working as an architect for a while and helping with urban planning in low-income areas, we experienced such a horrible financial and currency crisis that it crippled really the living standards of all the community I was working with. We were giving technical assistance and loans and helping them build their own houses in some of the shanty towns. And these people couldn't care less whether the houses were square or round or were standing up. They just didn't have anything to eat. It was really a devastating situation. And I slowly got interested in economics and particularly in currency crisis. And I ended up drifting away from architecture and urban planning and getting more and more interested in economics. Initially, I came to the US to do a master's in what was called urban planning and economic development. And in order to do that, I was required to take some economic classes, some principles of economics, which I took at Columbia University. And I fell in love with economics. I was fascinated by my understanding of how these things worked and pasted together. And I quickly realized that I didn't want to do urban economics, which is what I was heading into, but I really wanted to do macro and currencies and currency crises. In order to be a serious economist, I needed to do all my undergraduate in economics, and then I applied for a PhD program, and I ended up specializing in international economics and writing my dissertation on currency crises. That's how I got into that. And when I graduated, I ended up going to work at the International Monetary Fund. I ended in the division at the time was called Policy Development and Review, and I was really focused on the balance of payments and currencies as well. And of course, had the opportunity to travel around the world and experience what the IMF does in its surveillance and its program negotiations. And here comes the Goldilocks years, just before the global financial crisis, when we started to have a debate on whether the IMF was still relevant, because at the time, all the big countries had repaid their loan programs. We had the low-income countries had a different kind of financial aid from the IMF. But because the world was doing so well and we didn't have this big currency crisis any longer, the IMF was actually shrinking at the time and the private sector was booming. So that's when, in 2006, I decided to jump into the private sector. I ended up at Citi initially on the sell side. And after a few years there, when we actually had the global financial crisis come through, a couple of years later in 2008-9, I ended up moving from the sell side to the buy side. And I spent the last 10 years in macro hedge funds. I started at Soros Fund Management and went through a few of macro hedge funds, Larian Capital, Citadel, and now at Alphadyne.
Just with your experience at the IMF, I'm sure you came across all of the work that they have done along the way. And it sounds as if your tenure there was probably shortly after a lot of the currency crises in the 90s. Just was maybe
That's
a
right.
short period of time there, but you had the ERM unfolding in, I want to say 92. You had tequila crisis in 94. You had the Asian contagion in 97. Argentina in 2001. There was a pretty good stretch there of unwinds. I find currency crises so interesting, and it's not my particular area of expertise, but there's just so much there. And I think as you point to, and it seems as if it pushed you this way, that there's real social implications oftentimes of these regimes that become unstable. And this is probably maybe too big a question to ask at the outset, but perhaps you can try to give us some overarching framework for the why, or maybe there's a set of whys that might typify when a currency or when a regime becomes unstable and ultimately buckles down, that sort of gives way. What are the types of things that, in your experience, have been most relevant to episodes of currency crisis?
It is quite interesting, actually, to look back at the 90s because it is so different today. We actually have a big break, what we've seen this year in how emerging markets have been able, most emerging markets have been able to deal with the current crisis of 2020, which is that they've been able to allow their currencies to take the shock, to depreciate, and they've been able to actually cut rates as opposed to hike rates to defend the currency. That has allowed them to do countercyclical policy and help their economies in the middle of this downturn. Back in the 90s, they were in a very different situation, and we had a very different outcome for a lot of things, not only for internal reasons in these emerging markets, because there's also global reasons why this is the case. There has been some big important structural shifts in emerging markets. So to answer your question, I think the classical scenario for an emerging market that would experience one of these big currency crises, we would have an emerging market that had a fixed exchange rate or a peg, a crawling peg or something of the sort. And they were conducting at the same time very loose fiscal and monetary policy. So over time, what that ended up meaning is that the economy was overstimulated, and that would actually mean that the current account started widening and the exchange rate, the real exchange rate, became overvalued, so that the country was no longer that competitive. So their exports were not growing as fast as their imports are growing. And the growth was very dependent in external financing to come and sustain that current account. When you had a sudden stop of that external financing for various reasons, it could be self-imposed reasons, it could be an external shock, it could be maybe a terms of trade shock, there could be many reasons. The balance of payments of the country became very weak, very fragile. By that, what I mean is the amount of flows that were coming in the country were not enough to finance the amount of financing the country needed to sustain their growth and their import demand. So as a consequence, the demand for foreign currency was much higher than the demand for domestic currency, and the pressure on the reserves of the country increased to such an extent that the central bank, in order to avoid a very abrupt and big exchange rate movement, has to sell the reserves, and the reserves begin to dwindle and dwindle and dwindle to the point that the central bank can't defend the peg or the crawling peg anymore, has to let the exchange rate go, and the exchange rate experiences a big jump, being hugely destabilizing for the country that has been used to do all their transactions at a particular fixed nominal exchange rate that the government was maintaining for a long time. Because this happens so abruptly, it tends to be very distressing, and it obviously has a huge pass-through to inflation, especially for the emerging markets that tend to export commodities and import pretty much everything that is intermediate inputs or consumption goods. So it's a big shock for the purchasing power of consumers and some of the purchasing powers of the local enterprises, and the economy tends to take a big hit. And in a lot of these emerging markets, these big depreciations tend to be contractionary. Not in every place, not every time. So this is an idiosyncratic empirical question, but in a lot of these emerging markets, they're associated with contractions in output. So one of the reasons that has helped emerging markets this time around is, I think, a couple of important reasons. One is they have a lot more reserves, a lot more cushion in their reserves. So that allows them to use the reserves to smooth fluctuations in the exchange rate a lot better than they did in the 90s. Of course, a lot of these countries are actually floating their exchange rates. So they don't get into situations of huge overvalued real exchange rates like it used to happen in the 90s. So the floating exchange rate does play a role in absorbing shocks, even though, of course, we can still have big jumps in the exchange rate, but just not as big and with not as much pressure as we had in the 90s. And another important, I think very important difference is that the debt is now mostly in local currencies in most emerging markets, as opposed to what we had at the time, which was the debt in foreign currency. So because the debt was in foreign currency, the central banks and the governments were more and more reluctant to allow the exchange rate to take the shock and depreciate, because that would actually increase the liabilities and be a burden for the country a lot worse once the exchange rate adjusted. Having learned that lesson, a lot of these emerging markets have shifted their foreign currency debt into domestic currency debt, and now that's no longer an issue. So if the currency depreciates, their debt actually does not increase at all. In the contrary, in some places where, in fact, their net balance sheet is actually long dollars because of their reserves, the net position may actually increase after an important depreciation of the exchange rate. So the situation has actually changed dramatically for most emerging markets. But of course, we still see countries with problems on that front, like Argentina, like Turkey, etc.
When we look at some of these big events, and I'm thinking Mexico 92 and call it Malaysia, Indonesia, even South Korea in 97, there was, I think it was called original sin, which is this
That's right.
mismanagement of reserves and borrowing in foreign currency and being effectively vulnerable to that correlation. I was hoping you could talk a little bit about the Asian contagion episode in 97. I was reading Tim Geithner's book, mostly on the financial crisis, but he was at the IMF for a period as well. And he spoke a lot about the Asian currency crisis in 97 and how involved the IMF was involved, sometimes in a controversial sense. But my understanding is, as you were alluding to, there was a lot of capital that came in, there was a sudden stop of it, and then it just rushed out, and that created a lot of instability. Tell us just in terms of your assessment of that period. And then just the other part to me is very interesting is how does a currency crisis become more of a macro event versus being more of an isolated idiosyncratic crisis? What are the things that make it matter to the rest of the world that we should be thinking about?
Contagion is an interesting topic, and I think it is not necessarily well understood. Sometimes the contagion is very obvious when the reason for the currency crisis to happen in one country has parallels in other countries that are run in a similar way. In the case of Asia at the time, in the 90s, you had many countries that had fixed exchange rates or pegged exchange rates. You had many countries that had the FX denominated debt, particularly in the corporate sector, in the private sector, that became liabilities of the public sector. When there is a sudden stop to one country that generates a big adjustment in the exchange rate, what the market participants do is immediately look at any other country that may look similar and that would have similar risk, and they would position themselves to protect themselves from that risk of contagion to that country. You could even, it doesn't have to be emerging market currency crisis, you could even think about the European periphery as well when in the European currency. So the contagion normally happens when you see an event in a country and there's very close parallels in other countries and other sovereigns that are operating very similarly and that are affected by similar shocks to the system. Sometimes there is small contagion when there is a perception that there is a country in the region. Maybe there's going to be something similar in other emerging markets to the region. But what the market has been very good at doing as of late is just to realize when things are very different. So, for example, in recent years, in recent times, when you had the Argentina currency adjustment or even the Venezuelan hyperinflation, it has not had important contagion to the rest of Latin America, mostly because other Latin American countries are now operating very differently. Right now, Argentina has a huge amount of dollar-denominated debt. That's not the case in Brazil, for example. So there's no reason why a big depreciation in Brazil would have the same effect as a big depreciation in Argentina today. So now the market can differentiate which countries look very different than others, and the countries can suffer some. You can have the situations where these emerging markets have big adjustments without that spilling over into other emerging markets that have better fundamentals in the sense that they are better able to avoid big depreciations of the exchange rate because their balance of payments are in a much better position and their debt levels are in a better position, or the composition of their debt is in a better position. So that actually has made a big difference. But whenever at the time in the 90s, there were a lot more countries that looked very similar to each other. And when you have a sudden stop, it will transmit from one country to the other quicker. Then you have things that could correlate in terms of trade shocks. So of course, if you have commodity prices collapse, then all commodity currencies are going to take a hit. If it's oil prices, then oil exporting countries are going to take a hit. But that's not so much a contagion, but more of the same root cause for the currency adjustment. That is Russia, Venezuela, Nigeria, Canada, even. Every country that is an oil exporter is going to have to adjust to the new reality, for example. Or in the case of copper, you would have Chile adjust. But that's just in terms of trade adjustment rather than a contagion argument.
One of the things that you referenced was that sometimes these situations just become unsustainable and there's really no way out. That perhaps the best central banker in the world couldn't navigate through this, but perhaps sometimes the choices of governments and central banks, once they're inside a crisis, really do matter. And I was hoping to talk a little bit about the Eurozone sovereign crisis in 2011, 2012. That got pretty macro in a lot of ways. We would wake up and we would look at where the euro went, and you had a pretty good idea as to what was going to happen to the US VIX that day. The center of the storm was really in Europe. It was in sovereign spreads on Greece and Italy and Spain and so forth. And you had a transition from one central bank head to the next, from Trichet to Draghi, and you had a different result. And at least as I listened to folks who traded through that the appearance of Draghi on the scene really did matter from a confidence standpoint. How much of these accidents are self-imposed from a policy standpoint or a reaction standpoint, and how much of them are just there's just no way out because the economics are overwhelming?
It's a hard question to answer. I do think the central bank in that case mattered an immense amount. But I would just give you the disclaimer. I'm not an expert in the European crisis as much, but I would say that in terms of the European experiment at the time, when you are saying that it became a macro event and everybody was watching the euro, I think that takes us back to the importance of currency in these macro events, because it is interesting that the problem that you had in the euro area was that you have very dissimilar countries with very dissimilar macro, from Greece to Germany, and they all have the same currency. So they have to adjust through other policies, other ways than through the exchange rate, through their macro realities. Whereas Greece would have had an important nominal depreciation of its currency if it had been floating its own individual currency. It couldn't do that because it wanted to stay in the euro, using the euro as its currency with the rest of Europe and with other countries that were very different and required a very different adjustment mechanism than Greece required. So what is interesting is because when you have a situation like that, what you do need is a real exchange rate adjustment. If the real exchange rate doesn't depreciate through a nominal depreciation, because your nominal exchange rate is effectively the same as the Eurozone, as the same as the German exchange rate, then the only way you can adjust is through prices. The real depreciation happens through deflation, through price adjustment. So that depreciation did happen, and Greece did suffer a few years of very important deflation, which is what needed to happen, and absorption contraction in the economy. And once that happened, then the country was then able to withstand and crawl out. Of course, the fact that the central bank was there to help and act as a monetary union, which they are, and they decided to stay in. So Draghi, of course, with a whatever it takes statement, was of utmost importance in supporting the euro, in avoiding a breakage of the currency area. At the end, the real depreciation happened anyway. It just happened through deflation as opposed to nominal depreciation. And there is an important debate of which one's better. Is it better to actually have contraction in output and experience deflation, or is it better to have a contraction in output and a nominal depreciation, like many have argued for emerging markets? And it's not clear. Different countries have gone through different experiments. Clearly, the likes of Greece made their choice. You have a very different situation in some of these emerging markets that allowed nominal exchange rate to fluctuate, but not all of them. You have places like Ecuador, which decided to dollarize, which means they're not even part of monetary union. They just are outright using the dollar, which means that their adjustment has to happen through prices. And it's which adjustment is better is a matter for debate. Some argue that the nominal exchange rate adjustment is much better. It's quicker. You go through the adjustment quicker, and therefore the argument that contraction in output is shorter lived. And the other argument is that creates a lot of volatility, a lot of uncertainty, and it's actually worse than to enjoy the stability of a more stable nominal exchange rate while having a slower adjustment in prices. I think that's very dependent on the particular country and the particular economy and on which way it's better. But it's definitely clear that without a strong hand at the central bank of a monetary union of very dissimilar countries like the European Union, this would not have been possible.
Given your time at the IMF, I wanted to get your take on what seems to be a rethink of their recommendation in terms of how to respond to periods of crisis. And I'm just remembering back perhaps a decade ago as the Greece situation was getting more untenable. And in the aftermath, the debate was about austerity. This was the Reinhoff and Rogoff, this time is different period. And the view was you had to essentially cut your way back to prosperity. And it's almost as if there's a complete 180 at this point. It feels pretty global that around the world, there's this view that governments are supposed to run bigger and bigger deficits. Perhaps it's because rates are so low and the money's there for the taking. I'm curious if you can provide some of your thoughts on that.
I think the situations are different. So, of course, I haven't been at the IMF for many years now. So it's been since 2006. So I follow it from the outside rather than internal debates. So with that disclaimer, I think the advice of the IMF has evolved over the years. But in general, austerity is prescribed when the instability in the country, like we were discussing at the beginning, is a consequence of too loose fiscal policy that tends to be financed or allowed by loose monetary policy that then threatens the stability of the balance of payments. And in that situation, you're basically spending beyond your means, and you're going to end up in a very tough position in the future if you're unable to secure financing for your spending and for your continued growth. So in order to have a stable macroeconomic environment, which should foster productivity and investment and so on and so forth, you want to have something that is sustainable in the future. And if the IMF perceives that in their assessment and in their analysis, the spending that is happening in the country is unsustainable, and there's a risk of developing instability for financing in the future, be it domestic financing or external financing, then the advice is going to be to cut spending so that it's more sustainable. Even the situation we are in 2020, where we're having this big fiscal deficits everywhere, I think it's a different situation because the reason for the big deterioration on the fiscal is because of an external shock with this pandemic is here dampening the fiscal revenues on the one hand because the activity has taken such a huge hit. And on the other hand, you want to support the families and the population that is unable to go out there and work for no responsibility of their own, but just because they're asked to stay home to stop the spread of the virus. So you want to be able to have some support, some financial support for these families. And it makes sense to run deficits in this, if you want, crisis, external shock crisis situation, which ideally we can grow out of in the future. So it's not so much an irresponsible spending, but a one-off, if you will, increase in deficits that hopefully can be rolled back in the future to go back to fiscal responsibility and fiscal stability. That said, outside the pandemic, we had seen in certain countries, not every country, but an increasing widening of deficits and increasing debt because of the reasons that you mentioned, which is the debate that because we're in a world where we've had very little inflation, very slow growth, and with interest rates have been trending lower over time to the point that we have almost zero to negative rates in most countries, then what's the problem with increasing deficit and debt if it's going to support growth and the cost of carrying debt is very low? And that, of course, I think has some merit. That argument has some merit because definitely the debt service cost is what matters from a flow perspective. So this is outside the pandemic spending. We are in a place now in the world where monetary policy seems to have reached its limit. There is more that they can do, of course, but we are already at negative rate territory, which has all kinds of separate consequences. And the pressure for fiscal policy to take more of the burden here is very big. And I think that for some countries, particularly in developed markets that are perceived as well managed, that makes sense. I think it's a riskier proposition for some emerging markets that are going along that path or at risk of going along that path. I think the credibility is more fragile and they have to be a lot more careful in going along that path. But that said, because we are in a world with much lower rates, then that is possible. What you do have to ask yourself, I think, beyond the short-term analysis of whether we can afford a higher stock of debt and pay with it because the interest cost is low, is the reason why we are in the situation where we are now. And there are different views on that. I don't think it's yet clear. Why do we actually have the savings glut because we have very little investment opportunities, or because the investment opportunities that we have are changing the nature of what it used to be before because they're more technologically intensive And so we are in a different world now. So there are many explanations of why we are where we are. It is interesting to note that the investment levels are low, that growth is low, and that inflation has stayed very low so far. And the question is, in order to keep the economy growing, have the increased injection of liquidity and very accommodative monetary policy of central banks around the world covered and avoided some cleanup in the economy, some pricing of risk correctly? Are we having a lot of zombie companies that are kept alive by such easy accommodative policy that doesn't allow a clearing of the economy and a productive growth to reemerge? And if that's the case, are we stuck in a world where we're going to be in very low interest rates for a very, very long period of time with very meager growth dwindling over time because productivity is remaining very low? Is that because of an unhealthy support from central banks, or is there something else going on? And I think that's the big question we have now for monetary policy and fiscal policy around the world. And is an increasing amount of fiscal policy then going to revert this? It's going to jumpstart productivity. Infrastructure investment is going to be helpful, and productivity growth is going to kick off from here. Or are we just perpetuating unproductive spending, and that is going to eventually maybe result in some sort of stagflation down the line? So I think this is the debate where we are now. I think in the short term, increasing deficits and increasing debt for this year made sense. But the question is more structurally down the line, whether we are doing what is necessary for productive investments to come back, or is this easy monetary policy something that is detrimental for productive growth? We need to allow for more adjustment to come.
Let's talk a little bit more about today's macro climate, because you've hit on a number of things there with the heavy hand of the central banks, and their interaction with markets seems to increase at every turn. Certainly 2020 was the first time the Fed bought private assets in credit markets. The ECB and the BOJ, they're no strangers to it. And these days you say negative nominal rates to someone and they don't really blink an eye. It's just we've been staring at these prices for long enough where we don't really react to them. But I was curious to get your take just in terms of how you think about the central banks as a price setter. So clearly in the depo rate for the ECB or the Fed funds rate, they're setting that rate. But you go out 10 years and you still see the German 10-year with a negative yield to maturity of 60 to 70 basis points. So that doesn't exactly feel like something the ECB is explicitly setting. But I'm curious where the markets are on their own versus just so heavily guided by the central banks.
I think the central banks are key here. The markets follow the central banks very, very closely because right now the central banks are almost the name of the game. What has happened is the heavy hand of the central bank, as you call them, they have injected an unprecedented amount of liquidity this year. The speed, the magnitude, it is enormous. The money supply is growing very, very fast. And that means that is lifting asset prices everywhere. And they're further signaling to the market, sometimes explicitly, sometimes less so, that they're going to keep rates low for a very long time. And as long as that's the case, that's what's lifting asset prices everywhere. So even though we don't have, of course, much of CPI inflation, we do have plenty of asset price inflation. And therefore, the markets, you could very well argue, would not be where they are today if it weren't for the central banks providing liquidity. Now, I'm not arguing whether that's the right or the wrong thing to do, because clearly we would have had a very tough environment this year had the central banks not stepped in. But the dichotomy of where the real economy is and where, for example, the stock markets are this year, which is hard to miss, it is mostly because of the heavy hand of the central bank and the enormous amount of liquidity injected. So that's lifting all asset prices, and it is creating asset price inflation. And the question to me for the future, clearly not for the immediate future, but longer term, is whether the combination of those very easy central bank policy with an increased pressure for fiscal policy, as you mentioned earlier, Is that going to result in more broader inflation to the CPI? And will the central banks actually allow inflation to run much higher for a while? And how much higher? And it remains to be seen whether those rates are going to stay that low for that long. At this point, that's what they're signaling, and that's what the market is pricing. Of course, there is right now disappointment with the growth outlook. The expectation that growth is going to come back and pressure inflation is now still very low. But we do have the risk of a stagflation scenario, which is clearly not the central scenario right now. It's just a tail. But there is a risk that we sustain very low growth levels and inflation begins to pick up. And then it's going to be very interesting to see what the central banks are going to do in that scenario. But it's probably a little too early to discuss that. But what is happening, and I'll take the opportunity to introduce it here since we're talking about asset price inflation, is that the digital currency world is taking a big push higher from these actions from the central bank. So you have all the cryptocurrencies having a very big bullish run, and you have all the central banks talking about central bank digital currencies. And this is happening mostly because we have our negative rates, zero rates, and negative rates elsewhere. So people are looking what other assets I can park all this liquidity in. We have a huge amount of liquidity still waiting to be deployed. And these crypto assets are one place that is happily receiving them, receiving all those flows.
When you step back and you look at, so we talked a lot about interest rates, and of course, they are incredibly low. Interest rate volatility is also incredibly low, in some cases, the lowest on record. And then currency volatility is very, very low. We've seen it lower. I think in the middle of 2014 was one of the lowest episodes of just a broad measure of currency vol. But it doesn't seem like FX is unstable. And yet, as you say, there is a lot of debate about the future of currencies. And maybe we put Bitcoin as a currency in quotes, because some people certainly think about it that way. Others think about it as a project and a means of speculating. But talk to us a little bit more about your views on this asset class, sort of what it potentially represents. Is it something that folks should think about as part of their portfolio in a world where, as you suggested, interest rates feel like they're going to be stuck here for potentially years? How should people think about the world of cryptocurrency?
What I find interesting is that we do have more stability in the currency space because of the huge amount of liquidity, particularly dollar liquidity that we've had this year. We have a very big offshore dollar economy between 11 and 13 trillion. And when there's plentiful dollar liquidity, that helps growth and currency stability in all the emerging markets around the world. And it weakens the dollar relative to a bunch of other asset classes around the world. We have just plenty of dollar liquidity waiting to be deployed. And we have pretty much zero interest rates everywhere, zero to negative interest rates everywhere. So the places where you can deploy all this dollar liquidity become less and less. Of course, there's a bunch of those going to emerging markets to search for yield. And where else can you go to store your value or to increase your investment, because you're getting clearly no interest rate returns on your investment in the traditional fixed income space? And what happens with this cryptocurrency, particularly Bitcoin, is that you have the appeal of having a medium of exchange that is more and more, increasingly more and more accepted. It's still, of course, a long way to go, but it is getting there. We are seeing it in places like PayPal. We see it in Fidelity. We see it used a lot more than we had 10 years ago when it first started. So it's come a very long way, and it's probably going to continue to go in that direction. But it has the beauty that it has a fixed supply. So that's why people call it the digital gold. So it's, of course, much more portable than gold. It's much easier to transact on it, to transact in and out of it. But you have it in fixed supply in a world where anything that is in fixed supply relative to currencies that are being debased by the central banks is going to go up in price. Just as an asset price, like every other asset price, is just going to go up in nominal terms with respect to other currencies that are being debased. And the reason why that's the case is because the interest of the individual and the interest of the central banks or of the collective are in conflict here. On the central bank side, they want to support the economy, and in order to do that, they want to keep a very liquid economy with very low rates, very easy credit to jumpstart growth. From the standpoint of the individual that wants to save and have the highest returns for their savings and their assets, of course, what they want is something that is in fixed supply that would protect their value in time. So at this point, in the world we are in today, as long as interest rates are low and are likely to stay low for a foreseeable future because of the low growth environment that we are in, then assets like Bitcoin are going to be very appealing. And to the extent that they are more and more used as a medium of exchange, as the trend that we have seen so far, more and more they're going to continue to be appealing as a medium of exchange and as a store of value, that because so little percent of the population around the world have them or own them, there's still a lot of space for that to grow, for the market cap to grow from where we are here, which has been growing quite substantially, but there is still a lot of space. We are now about 400 billion in market cap, and I think for all crypto assets, it's about 600 billion. So there's plenty of space to grow there. It's still a substantial market at this time. I just wanted to conclude that I think that it's going to be in the interest of every investor to have a percent of their portfolio exposed to this asset and to understand the difference between these crypto assets that are in fixed supply to other crypto assets that are very different, like stable coins, like Libra, which is basically mostly an SDR. There are all sorts of digital coins. The central bank digital currencies are centralized assets. Bitcoin is not, it's decentralized, and that's the beauty of it, that it's not controlled by any particular central bank or particular organization that has conflicting interest with the interest of the coin holder.
In this environment, and again, perhaps it is the central banks, or just this may be where the global financial system has found itself, but we're really forced to think about options, meaning those types of assets that have potentially very asymmetric payoffs. And I think I would put Bitcoin in this category. One of the things I find personally compelling is the price action this year. Obviously, it's been a great year from a return standpoint. We're probably around the same level, maybe a little bit higher than we were in 2017, but the volatility is just much more controlled in 2020. So it's a small fraction of the incredible vol that we saw in 2017. And of course, that came undone pretty quickly. I wanted to circle back just to FX. And we were talking about the reasonably stable profile, just as per what the options markets will tell us, certainly about most developed market currencies. If there's a place that you're thinking about just in terms of where instability might originate, oftentimes markets, they just seem to miss something that might be hiding in plain sight, or perhaps it's just risk-taking that pushes prices to levels that become unstable. Are there areas of concern for you in terms of just the broad asset class of FX that the market may not be sufficiently pricing?
What is important to understand in these markets is that because these are liquidity-driven markets, in my view, you are going to have a lot of these currencies, risk currencies, appreciate relative to the dollar. We've already, of course, seen some of that, and we're going to continue to see that, in my view, because we have plentiful dollar liquidity, so likelihood of the dollar trending weaker relative to higher yielding currencies or all these emerging markets or all these where growth is going to resume is likely to happen as these go to seek yield. But the problem when we have these liquidity-driven markets is that things become a lot more correlated. They all move together because people are buying their exposure to markets just to get some yield somewhere, and they tend to disregard more and more the underlying fundamental of what is it that they're buying. And they're in the markets where vol begins to slow and everything, a dollar liquidity is plentiful, all the current account deficits are well financed. It's very easy for the markets to get complacent and to get very highly correlated. So then it's just a very fragile market. And even though I can't necessarily predict what's the reason for a particular disruption in the market that we may have next year, there could be some issues we had with the COVID vaccine, for example, or we could have any political disturbance or geopolitical stress of some sort or anything that would have the markets doubt on having this risk-on stance that we have now is going to probably have a pretty nasty pullback with everything very correlated with each other. I think as long as interest rates stay low, it's going to be short-lived. I think we may have nasty pullbacks and then we may have liquidity flowing back into these markets. I think it's going to be a different ballgame if we begin to see inflation and we begin to see central banks suggest that maybe they're going to stop the accommodation and maybe raise rates. I think we're very far away from that. So I don't think this is a near-term risk, certainly in developed markets. But of course, when the time comes, that's something we should talk about. I think right now we're more likely to see exogenous reasons that may cause risk aversion, and then we may see pretty bad correlated pullback in markets.
Excellent. I wanted to finish, Tania, just by soliciting some of your views on the progress for advancement of women in the field of finance. So you've earned a PhD, you've taken your career very far in a male-dominated field. You and I met, and you were kind enough to participate in the Women in Finance event that I hosted a couple of years back. I'd love to get your assessment, maybe kind of an update on the progress there, certainly amidst the crazy year and challenging year that is 2020. What does that look like from your perspective? What's the progress and what still needs to be done?
So thanks for that, and thanks for the invitation. And I think that it's an important topic, even though it's very hard to address. From my standpoint, I can't really see the whole industry and how things are evolving. But from what I can tell, I think I'm very happy to see women are continuing to make progress. And in the industry, there is more and more opportunities for women, certainly at the junior level than when I started out. I think there's plenty to go. I think the more women that take an interest in the field and are giving the chance to move forward, I think the better we're going to be for it and the more diversified the funds are going to benefit from cooperation of more senior women in the field. I think it's very hard for a quick progress to happen because normally the field wants to see proof of returns, of track records, and trust is very important. So it takes time to build. But I think it's encouraging that there is more and more opportunities to do that. I think my 2 cents for women out there is to be patient, to be persistent, to be flexible, and to just keep at it, keep trying. And there's different avenues that open up. And we're going to see more and more women continue to flourish. So I'm very excited about the future. I think we're going to continue to see a lot of progress in that area in the very near term. There's a lot of pent-up talent waiting to be given a chance.
Our listeners will certainly get some insight into one woman's expertise through this call. So, Tania, thank you very much. This has been a learning experience for me. And again, I'm sure our audience is going to appreciate your insights. Thanks again for your time today.
Thank you. Thank you so much.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback. As we aim to utilize these conversations to contribute to the investment community's understanding of risk, your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.